Welcome to the Cash Rich Exit podcast, your go-to show for building, scaling, and ultimately selling your business with purpose and profit. I'm Colleen O'Connell-Campbell, wealth advisor at RBC Dominion Securities and your host. Today's guest is Chad Morissette, a tech entrepreneur turned managing director of Mor-Liquidity M&A, a boutique advisory firm helping mid-market business owners prepare for and navigate successful sell-side transactions. Chad will be sharing his strategies, the ones that he uses to help founders extract a maximum value from their exits. Strategies born from both his advisory career and firsthand experience selling his own businesses. Welcome to the Cash Rich Exit podcast.
Good to be here, Colleen.
So you are currently working in the field of M&A, supporting on the seller's side. But before we get into what you're doing now, why don't you tell us a little bit about your background, because it certainly informs what you're doing now.
Sure. No, happy to. So I won't go too far back. It says I don't want to give away my my age too much, but
It's only a number.
yeah, it's only a number exactly. That's what I don't feel that every morning I wake up, but it's a good approach to take for sure.
Right.
So as it relates to M&A, I'll just kind of go back to that. So I was fortunate enough in the late 90s to be part of a dot-com startup that I was the head of sales for, and we went public on the NASDAQ. So that was my first experience with an exit in the form of an IPO. After that IPO, I left the company and I started my own software business, and I grew it both primarily in Canada. It was the first what we call SaaS software product back in those days, and SaaS wasn't.
Everybody knows what a SaaS
Yes, we didn't
is
call it
now.
SaaS. We didn't call it SaaS then, but it's
Mhm.
just to kind of frame it in today's software world.
Mhm.
So I grew that for 5 years. And then I ended up selling it to a firm based just outside of Boston in 2004. And so I went through an exit of my own software company. And without going through all the details, I was engaged for an 18-month transition as part of that exit. Then I took about a few months off after that. And that's when I kind of decided, okay, what do I want to do next? You know, what's my next sort of iteration of my vocation? And I decided to acquire three M&A franchises that were in South Florida. In 2005, I bought three offices, and it was primarily more Main Street style businesses, so the
Mhm.
smaller ones. And we had a team of 50 staff, and I grew that. And then the 2008 crash down in the States happened, and so that
Right.
rejigged everything. I was part of a franchise system, and at that point realized that I was a terrible franchisee. So I got out of the franchise system and started my own M&A advisory firm in 2009. And I've been doing that now. It'll be our 20th year. Personally, myself, 20 years since I started the M&A field in terms of
Right.
helping and coaching and advising other business owners on, how to prepare for an exit and then obviously how to achieve a liquidity event.
Full circle.
Yes.
Full circle moment. So I'm a little bit curious about why you were not such a great franchisee.
Well, it's interesting because I didn't have any experience in franchising at that point in time, but over the 20 years, I've sold a lot of franchise resale businesses,
Hmm.
and I've been exposed to the very large players and then the smaller franchisor players. And what I realized was, being a franchisee is to some extent, it's, being an employee, right? You have a system you follow. There's a reason why franchising is, typically one of the more successful business endeavors because they have a methodology, they've got a manual, they have a system, and you follow it. However, I felt at the time that there wasn't a lot of wiggle room in terms of entrepreneurial sort of creativity. And I kind of wanted to do it my way versus the franchisor way in my experience, and that doesn't often work. So I just came to the epiphany that look myself in the mirror and say, you got to go out on your own.
Right. Right. Makes
Yeah.
sense. Okay. There wasn't like some kind of like specific monumental situation. And maybe you wouldn't want to tell us anyway.
Yeah, no, I'm happy to share. Like we were part of a net. I own three franchises, and we were part of a network of 150 of them. And within the first year, we were the top five producing franchisees, but we weren't doing it the franchisor way. And so that created a bit of friction at the senior levels of the franchisor,
Mhm.
so it was just best to part ways at that point.
Yeah. Probably a great experience that has informed some of your processes when you went out to create your own firm,
Hmm.
right?
Absolutely.
Yeah.
No, and I think the big catalyst for me back in those days was I wanted to move upstream in terms of size of transactions. That was the real driver, and the business model of how to, make money in the business was very different in what I now define as the lower to middle market versus the mainstream market. It was just not it was not my wheelhouse in terms of comfort and sophistication.
Well, and that actually was is a good segue because I was going to say, why don't you tell us about this shift and the difference in terms of the businesses you're working with, and then how does that look like today? What types of businesses
Yeah.
are you working with today?
Well, I think, if you really, this is how everyone has a different definition for Main Street businesses, but Main Street businesses are typically, they may do, say, 500,000 in revenue up to, say, 1.5 million on the high side, 2 million in revenue. And,
Hmm.
so, definitely good, what I would call lifestyle businesses, good, decent going concerns. But there's a big difference between a company that's doing 1 million in revenue and say 30 million in revenue in terms of
Hmm.
sophistication of the ownership. The other part that comes with that is the teams that they have around them. So their advisory teams are far more experienced, far more sophisticated. It's a little bit, I shouldn't say a little bit, quite a bit less of what I call heavy lifting and education on when you're talking about the key talking points of exiting a business. So I
Hmm.
was just dealing in a sense with a different level of mindset
Hmm.
and sophistication. And frankly, what I realized, it was much easier to sell businesses with more zeros at the end of the revenue and profit lines,
Hmm.
compared to selling small ones. And obviously, the financial remuneration was much higher as well. So the
Right.
business model just made sense, and I felt really comfortable in that sandbox.
Okay, so can you give us a sense of the types of businesses that you're working with now? And we discussed this before we jumped in here to record something, but obviously you're not going to tell us the specific names of businesses, but give us a sense of what types of businesses, what industries, that kind of
Yeah.
thing.
So we kind of struggle with this internally. Do we want to be more niche or vertically focused versus
Hmm.
not? It's kind of always like a tug of war internally at our management meetings internally amongst our staff. So to respond to your question, we're industry agnostic.
Okay.
Um, that being said, I would say probably the last 5 years we've had a fairly heavy focus on what I would call the trades oriented sort of traditional blue collar slash gray collar business sector in terms of industry verticals. Just because a lot of those businesses are what I call mission critical value propositions, the services they offer. So whether it be HVAC, you have to have a furnace running in the winter. In the
Hmm.
summer, you need air conditioning. If you're running a very substantial roofing business and there's a leak, you need to fix it. So what I would call businesses that aren't necessarily ones that I hate using the word recession proof. However, if something goes wrong, they have to fix it. The customer
Hmm.
has to spend. So to go back to your question, I think we're very, very heavily entrenched in those particular anything that covers the home envelope, the physical
Right.
house or the commercial property, right from landscaping to concrete repair to general contractors to
Hmm.
electrical contractors, anything to do in that sector, we seem to have really built a tremendous track record. And size-wise, our sweet spot is we typically like to go as low as 1 million in EBITDA, and we kind of play between 1 and 10 million in annual EBITDA in terms of size. And that can, if you extrapolate that to revenues, that's typically, companies that are doing, say on the low side, 5 million, maybe on the low side, 10 million revenue, up to 100 million. But if you were just, kind of try and figure out exactly where we play, I'd say the majority of our businesses are between 10 and 40 million in revenue annually.
Okay. Yeah.
Yeah.
So, um, I mean, to categorize it, that does speak to the lower middle market for
Yes.
M&A, right?
Yes.
Yeah, as opposed to the Main Street or mid-market and so forth. Okay, that makes
Yeah.
sense.
Yeah.
And can you walk us through um, you are approached by a business owner, and let me just say, do you have people coming to you, or are you out looking for opportunities? Let me start there for a second.
Well, I think at this stage of our, I've been doing this 20 years. So considering hopefully I've done a semi-decent job and our team's done a decent job in the marketplace, I'd say the vast majority of our clientele is now through our referrals, right? So, I've personally consummated over 100 transactions in the last 20 years. So,
Hmm.
by default, you do a good job. Most business owners, personal and business networks are business owners. So if you deliver a good result, then obviously they start talking. And so I'd say at least 90% of our influx of new clientele comes through our referral network, whether it's business owners, accountants, are another fairly good lead source for us as well, is really where the most of the lead traffic comes in at this stage. Yeah.
Okay. Okay. And so once you're approached by
Mhm.
business owner from whatever source they're coming, um, walk us through the process. What happens?
Well, it's quite a process. So in a perfect world, we typically, depending whether it's US or Canada, but I'll
Let's
speak to,
focus on Canada because
yeah, we'll focus on Canada because it's a bit different from a tax planning perspective as well. In a perfect world, we'd like to start initial conversations around 2 years before they're thinking that they may want to exit from a timing perspective. And I won't get into the weeds why, but there's a lot of tax planning that needs to happen.
this has come
A
up.
lot
This has come up definitely in conversations. Unfortunately, there are situations where business owners aren't prepared, but this is why the 2-year mark is important.
Yeah, we've experienced that. I'd say the majority of them are not prepared. Although that has changed a little bit lately because there's a bit more content and knowledge out there that wasn't available before, and it's being preached a bit more. But I'd still say that, yeah,
Like the
people
Cash
like,
Rich Exit podcast.
yeah,
Yeah.
exactly. There's a lot we're banging out over the business owners' heads to say you got to plan. Don't put your head in the sand. Get it out of
Hmm.
the sand. It's
Hmm.
worth
Hmm.
the effort and the spend at this stage. So
So
back to
two
your question, I
years.
think,
Yeah.
2 years before is definitely ideal for us. And it's really a conversation. At the beginning, it's a conversation. And what I've learned the hard way in my early years of doing this was um, personal readiness is way more important than business readiness. And
Mm.
what I mean by that in plain English is really digging into the owner or the owners, because often there are several shareholders.
Hmm.
What is their personal motivation to exit? Like, what's the why? And that has to be really like that's where I pause and I let that awkward moment of silence kind of kick in is that answer is probably the most important answer that I look for. And the reason why that is that if a business owner is not 100% committed to an exit, it will fail
Mm.
all the time, all the time. Okay.
Mm.
And it's
Okay.
because they really haven't thought through, like we ask questions, what are you going to do next? Are you prepared for transition? Why are you doing this? Did you lose a close one to your family lately and it kind of created an existential crisis in your mind and your heart about what you want to do next in your life and how much time you have left? Or, you've got a new hobby, you're burnt out, you're sick of doing it, you've been doing it 20 years, 30 years. Like, what are the real drivers? And so it's almost like a bit of a therapy session at the beginning. I focus entirely on the personal motivation because if I really don't care about the business side until that kind of hurdle is cleared, because if it's not really well thought out and the answers are kind
Hmm.
of off the cuff, then it's a slippery slope, and everyone's going to end up sort of being disappointed or wasting their time. So once that block is kind of knocked off, then we really dig into this is another challenge we see is that a lot of business owners have never sold their business before. Obviously, we have some clients that we've sold their businesses several times. They're kind of the serial entrepreneurs, but those aren't the majority.
No, most are only going to sell their business once. And so
Yeah.
they're only going to go through the process once.
Yeah, so
Hmm.
they vastly underestimate every single one. I can't tell you how many clients we've sold their business and they said to, I'll talk about myself in this case.
Hmm.
Everything you said was correct, Chad. I never thought it would be this amount of work. I didn't think it would be
Hmm.
this difficult going through rigorous due diligence. I didn't understand sort of the process. I didn't understand, all the different levels of financial due diligence a sophisticated acquirer will do. Like it was really, there was tremendous amount of blind spots.
Hmm.
Okay. So we one of the things we mandate in as our methodology is that we do a due diligence stress test with every client that we onboard. And we charge for that and we give them a scorecard. If I was basically an acquirer, private equity firm, family office, a strategic, and we run them through a fairly rigorous due diligence, Q&A exercise. We give them a scorecard. And that's a real eye opener, Colleen,
Hmm.
because
I would
first of all,
imagine, right?
it's a huge eye opener because they have never been through it before. And they think, well, just, my P&Ls are tight and good and my balance sheet's good. It'll just sell based on my financial performance.
Hmm.
That's not the case,
Hmm.
right? So, where's the seller or the business owner going to get compromised? What are deal breakers? So that is something that we absolutely mandate. And it's a
I imagine you
tremendous.
get some really interesting feedback when you deliver this.
Yeah, I always say to the owners as you go through this, don't take anything personally. Don't be shy if all your answers, well, we don't have that, we don't know, we don't have the answer.
Mhm. You need
I
to
always,
be honest with it, right?
yeah,
Otherwise,
yeah,
it's not
it'll come out.
admissible.
And
Yeah. Hmm.
yeah, I always say to the client, I say, listen, every acquirer will find out everything. So full transparency, full disclosure. So when we go through this exercise, it's a real good sort of litmus test, sanity test of where their business sits. Okay. And then from there, obviously, it's the standard process where we create an outreach program to identify the potential acquirers, run that marketing buy side buyer plan through the ownership group, create the pitch book, all the materials, and then we start the outreach exercise. And that's typically from that point through to, having a transaction close with the legal teams. It can range from 4 to 8 months, depending on, the size of the business, and so many other variables. So that's our methodology. I always tell an owner it's, we're gonna know a lot about each other by the end. Most of the clients
Hmm.
of mine are lifelong friends. After the fact, I probably know more about them personally and their business and sometimes their spouses do. Because we spend so much time together,
Hmm.
right? And the other thing that I forgot to mention is that we also conduct what's called a net proceeds analysis with our owners at the very beginning. And this is a huge eye opener too, because there's often a discrepancy between the valuation the market will bear in terms of the business versus what the business owner needs from a financial comfort point of view in the context of retirement. So, if they sell their business for 20 million after tax, after paying off their balance sheet, selling costs, blah, 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 how much are they actually going to net? Because it's far more effective to address that at the very beginning and say, is this a pass or play decision for you?
Hmm.
Mr. or Mrs. Business Owner, versus getting 6 weeks towards the close and all of a sudden they have an anxiety attack because they think they'd be netting, more from the proceeds of the sale.
Right, right. And that ties in. So, I mean, what you've addressed here, the personal readiness, like the emotional side of
Yeah.
things, like the very human pieces. You've addressed the business readiness.
Mhm.
But now you're talking about the financial readiness that kind of connects the dots, right? And then
Yeah.
that's where where I'm doing work as well, and what I talk about is the wealth gap. So it's like, here are the assets that we have now. Here's how I envision my future later, which also ties into that whole personal readiness piece. It's
Right.
not, you can't look at them in silos, right? And then the wealth gap is like, what do I want slash need from the sale in order to make all that happen?
Mhm.
So having all of those pieces align is going to make for, a more successful outcome. right?
100%. And
Yeah.
we don't let the advisory groups, one of the things that I always like to do is make sure everyone's working cohesively as a team. There's no silos.
Hmm.
Sometimes we get pushback from our clients saying, well, I don't necessarily want to see the balance, you to see my personal balance sheet. And I usually say, listen, I don't care if you're worth a million or half a billion. It's under NDA. I just need to know all the pieces as part of your decision-making
Hmm.
process. And then we usually even get them to sign off on that net proceeds analysis. And why that's very effective when we do our job is that we tell the potential acquirers that we have an NPA executed by our clients, which gives them tremendous comfort too, because they don't like ending up at the 11th hour with the deal going off the rails because of that issue.
Oh, very interesting. So that's something unique that I haven't heard anyone else that I've brought here onto the show to talk about. That's a very interesting piece.
We force
Um,
it.
hmm.
We force it.
Hmm.
If they're
Fascinating.
not prepared to do it. And I explained to the business owner, in this case, the vendor, the seller, why that's appealing to the sophisticated acquirers, right?
Hmm.
Is that
Hmm.
they've done that exercise, they've spent their time doing it, and it's not, yeah, let's face it, I tell sellers as well that, the acquirers are going to spend hundreds of thousands of dollars, doing their due diligence, and they
Hmm.
don't want to waste their time and effort, and neither does the seller. So it's definitely something that we use all the time, and it definitely has, our closing ratio is grown significantly because of it.
Right. And so to reiterate, you work with the selling business owner, this
Mhm.
on the sell side exclusively.
No, I'd say
Okay.
80% of our revenues
Okay.
are sell side. We do what's called buy side engagements.
Hmm.
Like right now, I have a sizable company I know that's acquiring a firm in Victoria, BC. However, I'd say most of our bread and butter is on the sell side. We'll
Okay.
occasionally take on a buy side, but really all the stars got to line up.
Okay, okay. So you get the seller all set up. You know there's a personal readiness here. You
Yeah.
have a sense that there's a financial readiness. You've done your net proceeds analysis, and you've done the internal due diligence around the finances. So that's all aligned. Now, how do you shop this? Like, what is the process to
Well, here's
find
the
the
reality.
acquirers?
Here's the reality, and full disclosure here is there's no problem finding buyers.
Okay.
There's too much money chasing too few good businesses. So I don't want to downplay. Um, our firm gets probably somewhere between 5 to 10 unsolicited outreach inbound, emails or calls daily. Okay.
Oh,
From
wow.
PE firms, family offices, the standard template. We're this firm, we're got this much committed capital, we're looking
Hmm.
for this size of company. So, I don't want to say that our efforts to go out and find buyers is not an important piece of our value proposition.
Hmm.
But the reality is if you have a good business to sell and you got your ducks in a row and everything buttoned up, there are enough buyers out there. So, what are the buyers or how do we go the outreach? Obviously, we built a repository over the years. But, the numbers keep changing. There's somewhere between 5 to 15,000 private equity companies in North America, right?
Hmm.
So that are constantly raising capital. As we all know, private equity is almost taking over the world to some extent, even now in the lower middle market.
Hmm.
Family offices too, high net worth families that have either sold their business, etc. There's outreach that we do either via email, LinkedIn, very confidentially, of course, because this is something that's paramount for our clients. And then there's a couple of, what I would say recently, sort of AI buyer matching portals that are very niche centric too.
Okay.
And we've started to leverage those tools because the interesting stat is that 25 private equity companies only receive about 25% exposure of all the businesses for sale in the market. So it's very inefficient. But there are now some AI tools that we're leveraging that bridges that gap.
Now you've been at this for a very long time, 20 years. And like how long have you experienced this sort of like demand for buying these private
I think
businesses?
it's really been the last 5 to 7 years,
Okay.
as the demographics have changed, as different asset classes has become more relevant, as private equity's built a track record, and sometimes private equity has a negative stigma. It's like anything, you're going to have your good ones and your not so good ones in terms of return and execution of operating portfolio companies. But
Hmm.
um, when I say there's too few good businesses to sell, there really is at this stage. I'm not talking volume or quantity specific. I mean ones that are really run well, throwing off, cash flow, not owner dependent, have a good bench and management. Like I'm talking that kind of a company, right?
Hmm.
So,
Hmm.
um, and those are the ones all the acquirers, they want to de-risk their purchase. So I say when I brought that analogy forward, it was too much money chasing too few
Good business.
good businesses.
Right. Right.
Okay.
So,
Yeah.
I think of value to those who are watching or listening. Um, I don't, I think it bears repeating. It is been said, it's been shared here on the podcast and um, so forth, what those qualities are. I think it bears repeating because if there are too few, there's an opportunity here to be one of those really great businesses. If you're in
Yeah.
in a position where at some point in time you want to divest, you want to diversify, what have you, and that if that means selling all or part of the business. So share your thoughts around that.
Yeah, when we do that due diligence stress test, we basically analyze 18 different functional disciplines of their business. And in plain English, what I mean is that we analyze their marketing department, their sales, their operations, their HR, their finance department. I kind of look at it like a car engine. How are all the gears in the company working,
Mm-hmm.
right? And, like are your employment contracts up to date? Are you going through any lawsuits or pending lawsuits? Do you have a sales plan and methodology when you're on board new sales reps? The list goes on, right? Because from a buyer's perspective, every time they see more risk of how transferable that asset is when they take it over, it's like buying a used car. If it's been
Mm-hmm.
well maintained, when if someone buys a used car, they look at the service records, the mileage on the engine, etc. Well, the same thing goes for a business, is they're kind of they're buying a going concern, and what they care most about is sustainable future revenues and profits, and how much ease of transferability comes with taking over the business. And the other one that's absolutely key, and I always go back to, I used to do a lot of private placement investing myself, is always bet on the jockey and not the horse. And what that means is assess the team, right?
Mm-hmm.
Everyone's got a great, the business looks good, but who's the leadership? So if there's too much concentration in the owner's head and they're doing too much of the running the business, and this is kind of getting a little redundant because now that message is being preached a lot more than it was, say, 10 years ago.
Mm-hmm.
But the more dependence on the business owner, the more risk the buyers see. So less valuation and
Mm-hmm.
less favorable acquisition terms in terms of payment structures, right? And that goes for the bench as well. How much of a flight risk is your bench of key lieutenants? How long have they been around? Do they own equity? What's your attrition rate of your leadership team? Is it a revolving door? So all those kind of things, how old are they? I'm
Mm-hmm.
in the process of selling a business right now where, the buyer's very concerned that the management team is, 5 years away from retirement. Well, where's the next succession plan, right? So
Yeah.
all those factors really come into play.
Yeah, because we're talking about how do you make your business more valuable and make it attractive to sell. Um,
Yeah,
from the acquirer's point of view, yeah, you want to buy an attractive business. Also, where some of those pieces could use some tweaking, there's an opportunity to ask for a discount, get a
yeah,
business that you can then fill those gaps, increase the valuation, either for depending on what their purpose is. Family office, it might be about the ongoing cash flow that is built or profit from the business. A PE firm might be about building it and then reselling it.
yeah,
But whatever the case may be, that's kind of the flip side. As long as the risk is not too high, if I can get it
yeah,
at this price and build in. But if you're the seller and you want top value,
yeah.
fill those gaps yourself before you exit.
Yeah, and that's why I go back to the 2 year window that I mentioned earlier in our
Mm,
talk, is it's not just from a tax planning sort of runway perspective, but often when we do this due diligence scorecard, there's some major renovations that have to be done in the business,
hmm
some fixing, some value gaps that are significant. I had one client that took a year and basically replaced their entire management team. Okay. They thought they were good, but really they were, operationally weak in their specific areas of expertise. So that took a year. We brought in an HR, and then they went to market and sold because they realized that they'd be really beaten up based on the weakness of their management team. So, that's also the 2 year window from a planning perspective.
hmm
And one thing I'll say, I'm just kind of going off on a side note here, is I always like to remind the clients that there is no perfect business to sell and there's no perfect business to buy.
Right. There's
Okay.
better or
You
good
can,
or
yeah,
yeah.
you can improve, but you're never going to score 100 out of 100. So it's not like we're striving for perfection here, okay?
hmm
Because often some of the gaps that aren't real, sort of what I call deal killers or risk, very high risk for the acquirers, can actually be advantageous from a psychology point of view to the buyer, because the buyer say, well, hey, you guys are weak in sales marketing. I've got a great team here that we can just jump in and we can grow and scale your business faster because we've got better talent than you do. Okay,
hmm
so it's not like you basically want to go out and not show any sort of kind of what I call those light bulb moments for the buyer saying, aha,
hmm
we're strong on this, don't worry about it. We'll take over and we can, grow the business a lot faster and more effectively than you could, Mr. and Mrs. Seller.
Yeah, what's your opportunity?
Mhm.
Okay, so Chad, where do we find you? So somebody listening here today, watching us today is like, I like what Chad has to say. I'm really thinking about, the next step with my business. I want to at least have some kind of initial conversation. Where do they find you?
Well, I don't know if you want me to share but basically, I have private email, I've got my cell phone, and obviously we're on the web at www.more-liquidity.com.
Okay,
Uh,
more-liquidity.com. Okay.
yes,
And
and I can share my number now, or you can, later, but that's the way to do it. We also have confidential at more-liquidity.com, which is a generic inbox, very confidential, that just filtered by one of our key staff. So there's many different mediums, but feel free to share my contact information as well offline if you want to,
okay.
Colleen.
Yeah,
Yeah.
for sure. Well, anyone listening, feel free to send me an email, a direct message, and I can always connect you with Chad as well.
Thank
I like to wrap up my chit chats with asking for a piece of fun, frank advice. And would there be something else you want to add? But you just said a couple moments ago, I was feeling like that feels like fun, frank advice. But
Yeah.
regardless, do you have something you would add here?
That's a great question. I'm just onboarding a new staff member, so it's ironic, but a lot of my associates that work with me, I've sold their business, and then they decide they want to get into selling their business, selling businesses like I did.
hmm
And he asked me that question. I I think it's hard to sell a business. So one of the things I like to share with an owner is that it's an emotional roller coaster. It is full of surprises. There are endless variables. And then there's elements you don't control, like market conditions,
hmm
okay? Or news in the world, recession, interest, all the external factors that are out of your control. So I like to, it's not, it almost sounds pessimistic or sort of like, I just like to manage their expectations and know that 6 months it's going to be hard. And I also share with them that the last 6 to 8 weeks is the most difficult because there's a tremendous amount of work to be done in parallel with us, with our clients as owners.
hmm
And so I like them to understand that it's not just sort of like putting on the market and this is going to close. And that's where it's difficult to convey for our clients to understand because they've never been through the process. But I warn them along the way. I say, you know what, the next 3 weekends en route to close, you're not going skiing, okay? You're not going on vacation. It's going to be all hands on deck.
hmm
And then you're going to be exhausted when it closes. So I like to bring that forward because it is a significant commitment. It's worth the effort. However, it does involve a lot of work, especially if you're operational in the business. I always tell my clients you're going to be doing two full-time jobs for several months.
Hmm.
Are you prepared to do that?
So not pessimistic, but realistic, right? With
Yeah.
with the light at the end of the tunnel.
And I always say to my clients, focus on the payday, right? Like focus on the end result. Focus, I ask them, why do you want out? Well, I'm so tired of HR issues. And I always sort of dangle that carrot of a reminder along the way when everyone's exhausted, they're frustrated,
Hmm.
negotiations are getting hard. I said, don't keep your eye on the prize. Okay,
Hmm.
it's not that far off. And it usually gets them, I always like to say it's not a sprint, it's a marathon. That when
Hmm.
they get that marathon block at a certain mile marker in the marathon, that's when I
Yeah,
said,
well, as
it's
someone
here,
who's trained and run a couple of marathons, yeah, I can see that. And
right?
then you get really close to the finish line. And I remember my first marathon in particular. I've done two marathons, a number of halves. You know, not to compare, but halves are still pretty significant. But you get to that
Sure.
you get to that wall and then you
Yeah.
you get past it, and I remember saying to myself as I was approaching the finish line, I am not going to do the marathon shuffle across the finish line. So then you just kind of get this like mental boost and you sprint across the finish line, and
Yes.
then you take a deep breath and you walk.
Yeah. Yeah, you don't stop, right? You don't do a hard stop,
You don't do
right?
a
So
hard stop, but you do slow down significantly, and like I think that does kind of relate to the same thing. You may not want to go and necessarily crash, but you are probably going to want to like take it easy for a little bit, not jump into something else. There's just allow everything
exactly.
to just take a breath.
Yeah, I often tell my clients, park your money and lock it up for a while. Okay, like just to take a breather, right? Recover. You're
Hmm.
going to adjust to maybe having a new employer for a while. That's going to be tough. A lot of and I'll wrap up in a sec because I know we're close to the end here. But I've sold two businesses last month. I would say almost daily for the last 2 months, the owners called me just looking for pep talks,
Hmm.
like transaction, like, oh, I'm not used to this. Am I going to be getting my pink slip from the new they call all
Yeah,
kinds of calls, right? Because I've
right.
spent it's almost like I'm their best friend and therapist at the end. And I love that part of it, right? Because the transition after that's difficult as well.
Hmm. Hmm. No, because you're selling the business, but it's affecting the human beings.
It's certainly, and their sense of purpose too, right? It's if they
Hmm.
don't know what they're going to do next. Now, a lot of the businesses I do sell, the owners might have. It's interesting. A lot of the bigger businesses I sell, the number one driver for the owner wanting to get out is they want to get back to running a smaller business. So they want less stress, less people, less overhead. They just want to simplify things, and that's very common in my
Hmm.
client base now. They'll have a smaller business doing 2, 3, 4, 5 million revenue, 10 employees, and that's it's just they want to go back to that lifestyle.
Fascinating. Well, I'm sure there'll be more to share another date and time. It was great to have you on the podcast, Chad. Thank you so
Thank
much
you.
for investing some time with us.
Thank you for having me, Colleen.
Well, that was Chad Morissette sharing the more-liquidity process for selling with decades of experience helping mid-market founders and business owners achieve exits. I hope you found this conversation to be your wake-up call to start planning. If you're a founder thinking about your own future exit, this is your wake-up call. Start planning intentionally, strategically, and with the right partner. Self-Made Nation, if you'd like your own one-on-one wealth gap analysis tailored to your exit timeline, then please reach out to me, connect with me, Colleen O'Connell-Campbell on LinkedIn. Send me a direct message. You can email me, colleen.campbell@rbc.com. And if you found today's episode of value, I'd so appreciate a 5-star rating on whatever platform you're listening to this or here on YouTube. Right. So thank you for listening. Thank you for watching. I'm looking forward to welcoming you back again soon. I'm Colleen O'Connell-Campbell, Wealth Advisor at RBC Dominion Securities. TTFN. Ta-ta for now. All right. And before we wrap up, here's just a little quick note. All opinions expressed by me, Colleen O'Connell-Campbell, and any video guests are solely our own opinions and do not reflect the opinion of RBC Dominion Securities. This video is for information purposes only. Before taking any action based on information in this video, you should consult a qualified professional. I'm a wealth advisor with RBC Dominion Securities, a member of the Canadian Investor Protection Fund.